Italy's banking debt crisis has been described as toxic, with the potential to once again shake Europe's economy to its foundation. So it's little surprise that the government has decided to raise an extra $21 billion in national debt to prop up its banking system. Some of that money may be needed very shortly to save Italy's third biggest lender, Banca Monte Dei Paschi. Now the big question is, will it be enough? Our Azhar Sukri has more.
He's been in office for less than 2 weeks, but already Italy's new Prime Minister has been handed the political hot potato his predecessor managed to dodge. The country's banking crisis threatens to destabilise Italy's already fragile economy. So Paolo Gentiloni has been forced to act quickly.
We have
begun an operation that I would define as a saving of savings. The Cabinet meeting approved a document to go before Parliament which authorises the government to use funds. This, I want to say, is a precautionary measure. The authorisation is up to 20 billion euros. We will see if it's necessary. Anyway, we saw it as our duty to prepare this intervention to save savings.
Gentiloni's government wants to raise the national debt by up to $21 billion to cover any operation to stabilise its heavily indebted banks. He didn't say which banks may need help, but it's no secret that the first in line could be Banca Monte Dei Paschi, the world's oldest lender. It needs to raise $5 billion by the end of this month or face being wound down. Private investors have said they have strong reservations about helping the bank to raise even a short-term bridging loan that's key to keeping it afloat. So government aid may have to come soon.
So that 20 billion will certainly save Monte Dei Paschi in the short term. The problem is that Monte Dei Paschi has been trying to get a private sector bailout, but it's not been able to. But it doesn't, at the moment, it doesn't look like it's going to be able to. So that has a domino effect, and some of the other medium to small lenders in Italy also can't recapitalise, because it's not just Monte Dei Paschi with problems.
In fact, those problems extend even to Italy's biggest bank, UniCredit. Last week, it said it would raise nearly $14 billion in a share sale as part of a plan to remove around $19 billion of bad debts from its balance sheet. It's also cutting 14,000 jobs and closing a quarter of its 3,800 branches. Analysts say these measures should ensure that Italy's troubles don't spread beyond its borders, plunging the Eurozone into another existential crisis. But the country's banks face much deeper problems, the main one being that there are simply too many of them. Some fear that tackling those issues will need more than a simple act of parliament to fix. Azhar Sukri, TRT World.
And Azhar joins me here in the studio now. Azhar, so Italy's trying to solve this banking crisis by itself. Is this enough to calm fears in the EU, especially what's happened after Greece?
Well, it's a really good question. I mean, you might remember last year there was a massive run on Greek banks. About 3/4 of the deposits in Greek banks went away. A lot of those deposits haven't even come back even till now. So far, the ECB, the European Central Bank, says that the system is robust enough, that there are enough safeguards put in place, especially in the aftermath of the financial crisis, to prevent this, contagion spreading throughout the Eurozone. But the problem is that the European economy as a whole remains weak, not just in Italy. You still look at problems in Greece, you've got slowing growth in all other parts of the Eurozone. And apart from perhaps Germany, but even you've got problems there, and even in the banking system in Germany, you've got problems. So the point I'm trying to make is that with so much weakness, it perhaps doesn't take too much of a shock for weaknesses like these to become severe weak points in this system.
So authorities are saying the economy is robust enough, or the system is robust enough, but the truth is there are weaknesses in the European economy. How is this going to, is there going to be a spillover effect? Is this going to affect consumers in other parts of the EU?
If it does get worse, then yes. you saw this over 2008, 2009, and so how quickly it spread, spreading even to places like Cyprus and Iceland and places like that. Depositors lost billions and billions of dollars. So there is the potential for this. Right now, it doesn't look like it's going to happen. But as I say, there are so many uncertainties in the global economy that a sudden shock could expose some of these weaknesses, and we might be back to square one.
Okay, Azhar, thank you very much for that.